Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Worley, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Hey everyone, this is Dean Worley from the New Home Insights podcast. Today we're going to have Jeff Adler from Yardi Matrix on with us. Jeff, say hi real quick before I introduce the topic.
Hi everybody. I'm the Vice President of Yardi Matrix. Yardi Systems is a property management and technology firm for commercial real estate. We run about half the multifamily properties in the United States that are professionally managed, cover all different types of asset types. I run the data vertical of Yardi Systems called Yardi Matrix, and we cover a whole wide range of asset types: multifamily, single family, built to rent, student housing, self-storage, office, industrial. So, but my heritage is in multifamily, and that's kind of my first love.
Awesome. Before we get started, we're going to talk about a wide range of issues, including some stuff about the commercial sector that we don't usually cover here on the show. But I wanted to make an announcement for the show real quick. Jeff, please bear with us. New Home Insights is the winner of 12 Gold Awards. Now, if that sounds made up, it's because it is. I was just at the IMN conference in Las Vegas. Jeff, did you go to IMN this year?
I didn't make that one. No, sorry.
Anyways, driving to the venue, and I saw a billboard from a law firm, and it said, "blah blah blah law firm, winner of 11 Gold Awards!" Exclamation point. I'm thinking that sounds kind of like a fake thing. So why can't New Home Insights be the winner of 12 Gold Awards? We did one better. So we're the winner of 12 gold. Richard Manas, he does this with me. We are the winner of 12 Gold Awards. Please tell everybody that. So sorry about that. Let's get started here. I would be willing to bet that most folks, Jeff, have heard of Yardi and Yardi Matrix. If you haven't, you should have, because you're one of the best and biggest and most and kind of the key source of intelligence and data on a wide range. You know, it's not just apartments. It's built for rent. It's the commercial sectors like office and industrial and self-storage and student housing as well, too, which I didn't know about that. You guys covered that. So we're going to start with apartments. We'll talk a little about commercial stuff. We'll talk a little more about built for rent. That's such a huge sector, you know, it's dear to my heart. And then we'll end up talking maybe some kind of big picture stuff with Jeff. So let's get started with apartments and kind of broad outlines. How would you characterize the apartment market nationally right now? Rental rates, its hotness.
Yeah, well, I'd say it's pretty hot. And what really happened, there was a bifurcation. If we go back to sort of the immediate COVID period, right? March, April 2020. There was a real immediate bifurcation with the movement of people out of the top big cities into the sort of Sun Belt and Western. But in terms of overall rental rates, right, there was a deep declines in the major cities and modest increases in the Sun Belt cities. Well, February or March, it was kind of like a switch because the supply that had been kind of needed to be absorbed in a lot of these Sunbelt markets suddenly did get absorbed, and rental rates just took off like a rocket. So from March through August, rents have been just crushing in terms of growth rates. And it is most prevalent in, I'll call it the Sunbelt cities, where average rent levels from COVID, are up 20 to 30% higher than they were, kind of March in 2020. And even in the major kind of international gateway cities, those rents have kind of recovered, except for only two spots in the whole country: downtown DC and downtown San Francisco. Everywhere else, rents are either where they were, or slightly above, or just way above. And again, the way above is really a function of the movement of populations associated with kind of COVID and now kind of a lower cost of living.
Let's hold off on that stuff. We'll talk about that at the end here. Sure. But so I knew you're going to say downtown San Francisco, that the kind of core Bay Area really took a huge hit. Have they recovered? Are they still, you're saying they're still net down from the beginning of COVID, at least okay. Okay.
Yes, yes. So for example, San Francisco downtown, and I look at, I say downtown San Francisco. All right, at one time was down like 15 points in occupancy and 25 points in rent.
Yeah.
Um, through August, occupancy has recovered to where it was pre-COVID, but rents are still down about 12% on a new lease. Executed basis, new leases. I'm not talking about, there's still sort of a lot of leases that have to burn off. But again, that and DC are kind of the exceptions. Downtown DC are kind of the exceptions to everything else that's going on. So, just last month we put out a report that kind of said new lease growth around the whole country was up on an average of 10%. But we've got 10%. Some markets like Phoenix, it was over 20. Tampa, it was 20. Vegas, it was like 18, 19. That's like, I have never seen that kind of number, period. Yeah. Okay.
And funny how the hot markets are the hot markets.
So those are the hottest market
temperature and market.
Hot and business wise, and so, but even New York and San Francisco, and Minneapolis have at least now forward movement where they weren't there before.
Have we seen any sign of any kind of a normalization in the for sale sector? We're definitely seeing that. Maybe even depending on what market, we're seeing it for the last month and a half, 2 months. Yeah. We've seen clear signs, some anecdotal, but that it's more than seasonality and the market's calming down. Are we seeing that at all in the apartment sector?
I think it's more a return to a certain level of seasonality. I don't expect necessarily this level of growth to accelerate, right? Usually July and August are kind of the seasonal peak, and we do expect to see increases, but not at the same rate that we've seen. Okay. But still, these are, this is pretty darn healthy. And what I also look at is the month-to-month acceleration, and it's been pretty stout. I do think we'll see some kind of return to a somewhat normal seasonal pattern, where usually September through February are kind of the weaker part of the leasing year, and then it accelerates March through August.
So it's funny. That was my next question. Was your crystal ball says that we are going to kind of calm down here a little bit in the apartment market,
a little bit, but it's still pretty high. But yes, I do expect it to calm down some.
Do you do like national level prognostications, actually projections of year-over-year rents, say for 22 or 23? Can you share that with us?
Well, I mean, we do forecasts, both at a national and a market and even a sub-market level. And so, we do expect, this year to be, I'm rummaging around for my sort of crystal ball here. Nationally, we do expect, rents to be rather high, like in a 8-10% kind of range. We do expect that to come down, over the next few years and hit a more normal level as the supply response catches up to this shift in the demand curve.
That's another great segue, Jeff.
Yeah. So we do. Yeah, we definitely do have what's kind of happened, and so you see this burst, right?
Yeah.
And the reason that the burst happened was initially in the first wave of COVID, there was a fair amount of supply in the Sunbelt markets, and you can use Austin as an example, where there's a lot of supply in Austin in multifamily, and it took and Austin didn't show any rent growth for multifamily. And again, all the businesses were moving there up until this spring because there was a lot of supply to get absorbed, but the demand kept coming, and all of a sudden Austin went from no rent growth to bang, and you're in the high digits. And it's now last month it was up 15% year over year.
Wow.
And in Austin before that had just, so what's really happened is there was supply in excess of demand in a number of these number of these Sunbelt tech hub cities. The shift in the demand curve soaked it all up, right? And so as the demand kept coming, prices have escalated, and new supply is being added, but it will not deliver, in time. For the next, 12 to 18 to 24 months, it will come,
Yeah.
In because these markets are generally supply friendly.
Yeah.
But there is a period of time now where demand is outstripping supply.
That's interesting because again, to make a sort of a comparison to the for sale sector, we think there's been a lot of activity here this year from the biggest builders in the country. So we see supply increasing next year in calendar 2022. You're saying that, of course, there's a longer build time for apartments. That sort of next wave of supply is more like 2023-ish and 24?
It's with pretty much because of the time frame it takes to get permitted and get going and get through the planning process, and it does vary by city, and we take that into account in our delivery forecast. But we see 21 and 22 delivering about 355,000 or so units. We do expect the supply to ramp up 2023, 2024, 2025, but it's not as easy as it seems, because there is a process one has to go through. With the exception of Houston, when there's no zoning, there is a public policy process that has to be kind of worked through.
Yeah. No. Hey, high rise next to a church, go for it, says Houston.
Yeah. Right. But they're the exception as opposed to the rule around the country.
How about let's end the apartment part of our discussion with values. Where do you see? I mean, first of all, have property values for multifamily residential have they skyrocketed roughly in time with rents? And where do you see them going?
So what happened with values, and this is something we began talking about right after COVID, because there was a significant reduction in debt costs, and as a result of that, what we saw almost right out of the gate, we could tell is that values in the core cities would be level. We didn't see a lot of impending distress, and we didn't see it. We saw a few properties in trouble, but not a lot. And then we saw rather significant. We expected 15 to 20% increases in valuations in all the Sunbelt cities. We kind of seen that and more. So values are up a lot. What we call cap rates, which is just a way of a kind of a price earnings ratio, is now because of the drop in both interest rates and the expectation of revenue increases, it is pretty much everywhere sub 4, and you can even get in the mid 3s, and it isn't that hard to do in some of the hot growth markets. And it's because debt costs are so low, that's still a positive spread, and there's still an IRR. People are stretching. People are a little complaining about how competitive it is to get to buy assets. So obviously that's making development interesting, right? Because that creates an opportunity to develop, but it does take some time.
Now, low cap rates typically are associated with the idea that the investor sees less risk. Is it being driven by that now, or are these caps rate also being driven by the competition to place those dollars?
So one, it's driven by debt costs. Okay. It's driven by large by capital flows, right? Because that really is the sort of the competition for assets. What we're seeing here is, I'll call it asset inflation, right? So if you have a lot of money sloshing around, and there is a lot of money, and cost of debt being very low, and the prospect for rent increases, revenue increases being stout, not 15% by any way, but even a reasonable 4 or 5%, 1 or 2% over inflation. Historically, rents have gone up 1% over inflation. So what's your inflation number? At tag 1, then add on a couple extra, right? Okay. You can get to that number without being too crazy. Okay. And there is a lot of capital that's coming out of the office sector, that's coming out of the retail sector, that looks at multifamily and industrial as kind of the darlings of commercial real estate, and they want to get into the party. And so there's a fierce competition to put that money to work.
That is another great. You're helping so much with segues, by the way, Jeff. Because now let's turn.
That's my job, right?
Let's turn to the commercial market. So. Okay. And before we actually turn to one of my favorite topics, which is built for rent, we'll talk a little bit about commercial markets. So let's start with office. Do you see that? Is that bouncing back at all from the COVID shutdowns?
It is stabilizing. So the big issue, and it's not surprising, the big issue with office is, what is the future of work? What is the nature of the way work is going, particularly office using employment, right? What is the nature of how that work's going to be performed in the future? And that is going through a a sort of radical evolution, potentially revolution, right? Between how often do you need to be in an office? What's the value of teamwork, right? How does one build relationships at work? And so there's this very much of this push-pull, right? I mean, people have been working from home. Most of the employment has been working from home for 18 months now. They have a new routine. It's most employee again. There's tons of employee surveys. Most folks, let's say, if the people who worked full time from home were like 5%, that's gonna probably could go to 20 to 25%. Okay, so the people who work full time from home hardly ever come into an office. Then there's another big bunch that are kind of thinking hybrid. Yeah, I'll come in 2 days a week, maybe 2.5, whatever, yeah, okay. And then there's still about a third, I think, of workers will truly come back to work full time. And it's really industry based. If you're in the financial industry or certain deal teams, they need to be face to face, and they are right now face to face. So it really breaks upon, if you're looking at a city, what is the composition of industries in that city, right? That's why you see different New York versus San Francisco is a bit of a dichotomy, financial versus heavily tech, though New York has a lot of tech in it. So this is where this is all playing out. And there's really, everyone's feeling their way. And so for office, you see that new lease rates are effectively down 30%. A lot of companies are sort of rethinking their footprints. Nothing radical, nothing crazy, but trimming, kind of like scaling things back, sculpting, reorienting what their space could look like. And they have to be flexible because no one really knows. You've just seen Apple or Microsoft push back their return to office dates into January. And so that'll be almost 2 years. And so there's a lot that's still in flux. Though from an occupancy standpoint, things look like they've stabilized. From a subleasing standpoint, things look like they've stabilized. But there is a lot of space. The new supply pipeline there is declining quite a bit. But it's a sector where it's still in flux. That's
stabilizing, but stabilizing at a historically pretty low rate. Am I right?
And just again, everything the way the assumptions of the last 100 years have been significantly challenged. Right now, in 5 years, will we be reformulated back to the way things were? The issue maybe, right? But usually, when you go through these kinds of just revolutions, right? You don't come out the same way you came in, right? And so this sector is very, if you look at this, so much more in flux. The reason that multifamily in the Sun Belts are so strong is because of this exact issue on the office side.
Exactly.
Right? So they're basically, the other side of the coin.
How about industrial? I mean, research and R&D stuff, warehousing. That's kind of been the opposite of office.
So I would say in office, right? I was talking about general office, right? If I talked about lab space, or medical office, different story, different dynamics. Those little slices of the office world are doing great. Now, if you go to industrial, right, industrial is being driven by e-commerce, right? So there's an incredible, rents are escalating at an enormous level. New supply and demand are roughly balanced. So there's a robust new supply pipeline, but it's getting absorbed. I mean, Amazon just saying they're going to take down an extra 100 locations and, I don't know, 125,000 people, just says that, and Amazon has been like 35% or 40% of all the new absorption of industrial space in the US. So they have a huge role. And so industrial, again, is another one of the kind of investor darlings. It's got a lot of tailwind. And if there's any sort of reshoring of some manufacturing, that'll be an additional tailwind. So industrial is kind of on fire.
Do you see that? I mean, how long can that? It can't play out forever. Is that have a
forever's a long time. But if you look at the penetration of e-commerce into retail sales, it was growing at a certain pace before all this. It had like a one-time jolt, and it'll come down a little bit, but it's still, you're now at maybe 15% of total retail sales being in e-commerce. It could it could go to 30. I mean, so it may take 5, 6, 7 years to get there, but so that's a doubling. So it's got a fair amount of runway to it. And also I throw in, self-storage is on fire. Like, again, self-storage is a little niche sector, not doesn't set anybody's heart on fire, but it benefited from the movement of people. So self-storage did great in the course in the international gateway cities when multifamily got crushed because people were leaving. It did great in the Sunbelt cities because people were coming. It got to go better, and it was in such a dire issue with new supply. Street rents were declining for like 2 years. All of a sudden, boom, they're up 15%. So they've had a demand shift as well. So if I look at any asset type that is related to the housing of people or the movement of people, it's on fire.
Or selling people things, right?
Right. So all of these sort of COVID issues that were trends that were there that have been accelerated, right, is where things have kind of been going. And retail is struggling. It was struggling before. It's struggling still. It's finding a footing, right? Before, the savior of retail was experiences. In-person experiences were going to save retail. COVID blew that out of the water, right? So it'll find a footing, and there is sort of like the marquee best, malls and the best strip centers. Those are okay, but it's going through a transformation itself, where both retail and office are becoming more about the experience as opposed to the function. Again, so high variance of outcomes in those two asset types.
So that's exactly the point. If retail is not experiential, it's not for selling things. Everybody's they're buying things online. So your retail center has to be, or more so, So your retail center really has to be about enjoying yourself while you're there, because otherwise you wouldn't be there.
Right. Or even grocery anchored retail, which was the best things in sliced bread. Well, more of your food is being delivered, right? So anyway, so
and they hope to deliver it,
right? Well, the bottom line is, we're talking about housing and the housing of people, and like this, is the place to be. Like, where people live is where there's been enormous success, and also you got a lot of sort of tailwinds ahead of you. So it's a great bunch of sectors to be in.
How about student housing, though? That's a little bit different in terms of where people live, because people aren't physically on campus like they were. Has that sector been a little bit more like office and suffered?
Well, student housing did go through a shock, all right, because it's about the gathering of people, right? The gathering of the kids and being in person, and the 2020 school year was like, a cluster, right? And the fact of the matter is, going into the 2021, fall of 20 into the end of 2021, the sector didn't do so bad. It was 3-4 points off of leasing. Rents didn't go up much, but it didn't fall apart in any way, except, right? So the sector did fine, except if you were a school in a big city, right, where the state had kind of shut stuff down.
Okay.
New York, California, those schools didn't do well. Or you were a third-tier school. The schools that did well, and we can see a continued consolidation here, is major state universities where the population is growing and the business climate is pretty good.
Okay.
And so we're seeing this continued consolidation, right, where weaker universities are losing out and the stronger, larger universities are winning. We do see a trend toward hybridization of schoolwork, and education. But at the end of the day, this sector, kind of finishing up this academic year, has done great. Overall rent growth, it was 2%, which is good for student. Occupancies were sort of very close back to 2019. So as you go in from the 21 to 22 school year, but the bottom line is, just like in K through 12, people are going to go to school. There may be disruptions, but they're out of the house and they're in the school. So student housing, survived, and it actually proved its resilience. It didn't do quite as well as some of the other sectors, but it also proved its defensive nature.
That's interesting, because it might be a little bit like retail in the sense that college life, to actually want to go there, has to be, again, kind of experiential.
And it is.
right? And student housing coming back kind of
Right.
indicates that things are going a little bit back to normal.
Right.
I hadn't realized that.
And they had a bit of a tailwind because the dorm capacity just didn't quite work. The dorms weren't set up for social distancing, and they had to basically take out dorm capacity to have COVID isolation wards and stuff like that. So it actually, student housing did okay. And it's set up for continued. It's got demographic issues, which is driving it to consolidation. But the sector is in solid shape.
Okay, let's switch to one of my favorite topics, which is build for rent. First of all, build for rent versus build to rent. BFR versus BTR. It's a battle going on. Who wins?
So the sector that we cover, okay, is communities over 50 units that are purpose built to be rented. Okay?
Yeah, I mean, just the term. What do you think? It seems honestly,
build for rent, build to rent. So the way my little sort of thing is SFR BTR, single family rental, build to rent.
Okay,
there's a bit of a nomenclature war over exactly how you're going to call it.
Exactly.
I'll put in my 2 cents. We'll see what happens, right?
We use BFR, by the way, not BTR. Okay.
All right, but BFR, BTR.
Either way, it's booming. I know you track that space.
We do.
Single family rent SFR data was used as a proxy for a long time in the early going for build for rent, and I know single family rental on an annual basis, I something like 30 years has never had a negative year in terms of price change,
which is amazing.
That's incredible. What's happening right now with respect to, like you said, purpose-built, built for rent, or BFR, BATR, purpose-built communities of rental houses? What's going on in terms of depreciation right now there? In that sector?
I mean, so just to describe to you what we do, we have identified about 875 properties that comprise about 120,000 units of this sort of asset type, right? So remember, we have 19 million multifamily units, right? So it's small relative to multifamily. Obviously, it's also small relative to the single family inventory. So it is but within that 120,000, 35,000, right, and are in some form of new supply. So it was a super small segment, and it's growing rapidly. And the amount, there's like $11 billion that are committed to it, and there's more coming. So, and if you think about this sector, right? So, and I was involved in the single family rental business, a scattered site business back in 2010 with one of the earlier companies, right? So the whole sector began to professionalize coming out of the GFC, right? And it sucked up excess supply. And the big issue was to develop the technology to manage scattered sites, and they have done that enormously well, right? And then you got to a point, and this started pre-COVID, where certain developers, both traditional single family developers, as well as traditional multifamily developers, said, "Hey, you know what? We've run out of the cheap stuff that we can gather, scattered site. It's tougher, and we're going to go start building these communities purpose built, right?" And there's been a couple generations. Next Metro started out in Phoenix, which is the hotbed of it, where it was started out really for people who wanted pets, not 3-4 bedroom house, but 1 and 2 bedroom with a yard for a pet. And they've had success. And then and then Lennar has built some properties that look like real traditional single family 3-4 bedroom homes in a community that's centrally managed. And this sector, like with COVID, right, it was already kind of happening, but it's really quite small. There's a lot of runway here. Okay, if you think about the fact that single family homes are expensive and you still need a big down pay, and the demographics are that more people are aging right into the prime home buying years, and if they can't buy the home because of cost, but they still need the space, well, single family rentals that are purpose built are a great option. And again, if you look at this, if you go back 25 years, 30 years, it's single family is following the same trajectory as multifamily did coming out of the S&L crisis. Same trajectory, same level of technology development, same level of developing new communities built for rent. So this is a natural progression. The sector is burgeoning. There's a lot of supply coming. There's a tremendous amount of demand. We've done a lot of work on just looking at price points. The prices themselves are growing at twice the up until last month, right? So if multifamily was at, I think in July, multifamily was 6, it was 8, and single family rental built to rent was like 14. Then this month, with August, multifamily was 10, and single family rental 14. So, I mean, that's a big number. And again, like rents growing at that level probably are not sustainable forever, right? But for people, but the product type, it makes a ton of sense. There's a need. Most people are paying, not far off of what multifamily rents are. They're going further out for more space, and the economics are totally there. It tends not yet to be sort of families with kids. Families with kids, if they're renting a house, want an established school district, and that's really scattered site. What you're getting is people who are couples or couples with preschool age kids, or people with pets who need more space and are willing to go a little further out to get that space, pay about the same as what they were paying before, a little closer in, right? And because there's more flexibility about working in your work environment, that's not that big a deal. So the economics there are there. The sort of space trade-off is there. I think this asset subtype is going to do extremely well in the future. There's significant demand for it.
So speaking of that, I know in the SFR long-term data norm, it was kind of a slow and go price change. It didn't go negative, but it was slow and go. But 14% in the BFR world,
unbelievable.
Okay. Do you see that as? I mean, so do you see BFR having more fluctuation, more like apartments than SFR? Does that make sense?
Yes, I do. It will probably be more volatile than scattered site, just because of the nature of the renter and the decision making. And quite frankly, new supply will continue to be added, right? And so there will be more fluctuation in the rents, but the people who are in the business of managing them are in a better position to absorb that volatility and to manage that volatility, because it's professionally managed. They have revenue management systems, they have better marketing systems. So I think this subsector has a very very bright future for it.
It's funny you say that, because we do a lot of market feasibility studies in the BFR world and site-specific potential developments. And we've noticed that often if we're in a market that doesn't have existing BFR, which is a lot of markets still, shockingly, you often will look at apartments as a proxy, and then also the mom and pops, right? The single family, the scattered site things. We've noticed that the mom and pops in this fast-moving market, they just simply aren't attuned to how rapid rents have gone up, and they'll lag significantly time one, time two, the apartment sector. So the professionally managed BFRs can capture that, can't they?
And look, if you're a mom and pop and you have a small portfolio, you care much more about it's the same thing in the apartments, right? You care much more about the volatility of your cash flows, because you have to make your mortgage payments. And so you will not try to optimize rents. You'll try to optimize occupancy and accept suboptimal outcomes for rental achievement. If you're professionally managed, you're better capitalized, and you're going to go for the sort of optimization, and you're willing to accept some volatility in occupancy in order to achieve higher rent growth, and therefore also higher valuations upon exit. So they're different. They have different objectives as investors, and there's the sector's big enough for both.
Yeah, and of course, as we know, the vast majority of rented homes are from mom and pops.
Right, and it's a very kind of favorite asset class for the small investor, because the entry cost is lower, and there will be continued consolidation. I can go talk about how multifamily took many years for it to become more professional, kind of institutionally owned. Self-storage is still largely
Yeah.
mom and pop owned, but there is an institutional sector, manufactured housing, similar nations. So single family rental is going through that evolution, but it's such a huge asset class that it will take an extended period of time for this to happen. And there are public policy questions that are sort of beginning to bump up against: is that a good thing? Is it a bad thing? What's good about it? What's bad about it? If you look at the individual kind of a property owner has been the person who's borne the brunt of the eviction moratoria. Okay. And they've been the ones that have been most affected because they were the ones who tended to rent to, let's say, they didn't have, let's say, super professionalized screening, right? They didn't do a lot of rent to income analyses, and so they've gotten hurt, okay, and they're the ones who also have not really gotten any relief from the rental funds that are supposed to be there to cover those obligations. And there's $46 billion, which is supposed to go largely to them.
Okay, let's talk about supply a little bit. I know Phoenix is by far the king of the BFR world in terms of just volume of units.
Yes. And new supply, and the new supply is coming there. Sure.
I at the IMN conference I mentioned a little while ago, I can't remember who it was, but a panelist there mentioned that in a couple of the key submarkets in Greater Phoenix, like the Northwest Valleys, something like half the pipeline was for BFR units, half the residential pipeline.
Yeah, it wouldn't surprise me. I mean, there's look, if you've got apartment rents going at 20% a year, right? Like the economics of a single family home that's built for rent community is going to look pretty darn good. Yeah. So again, this doesn't surprise me at all. There's a significant shortage of housing in the Metro Phoenix area, largely driven by migration of people out of California. And that's affected Las Vegas, and it's affected Reno, and it's affected Boise, and it's affected to a lesser extent Portland, Seattle, and Denver, because they were a little more expensive in the first place. Yeah. But it's also affected Albuquerque.
Is there a next Phoenix for specific to BFR? Maybe not at that volume, but a next where you see BFR, a market where you see it just starting to boom?
Well, the Carolinas are busting out. Okay, so Raleigh, Charlotte, anywhere in South Carolina, Florida, Orlando, Tampa. These are markets where there's a pretty decent access to land, and growing populations and rising values and rising rents. So a lot of these markets are going crazy. Obviously, the Dallas Metroplex, Austin. So you pick any rapidly growing metropolitan area, and you will see meaningful supply, both in multifamily for garden apartments in the suburbs, as well as single family built for rent. Built to rent.
One thing we've noticed here doing these BFR studies as we do, I've noticed, I'm based in Northern California. I kind of cover Northern, Central, and Nevada. I've done studies all over the country, but don't have to get in a plane anymore except to Vegas occasionally. But I've noticed that the studies have gone from places like Merced or Modesto or Carson City, smaller, outlying, cheaper markets, and now we're in, hopefully, if you know the Sacramento area, places like Roseville, Elk Grove, more core, suburban, more expensive markets. We're starting to get some play in the core Bay Area and some folks looking at those kind of areas. Do you see that nationally? Do you see, because BFR was on a national basis, is in the cheaper, the relatively less expensive land markets. Do you see this starting to migrate into more expensive markets yet?
On the fringes of those markets, yes. Okay. I mean, look, in order to make the numbers work, land still has to be relatively inexpensive, because you're talking about, you can't go up in terms of the space, right? And part of it is, in fact, the fact there is no one over your head, and there is a little bit of space and a bit of a yard, and so it is on the fringes. Again, you have to look at the land use and the highest and best value of that land. And it is on the fringes, the suburbs, the outer suburbs of those major metropolitan areas. But those areas are growing rapidly, right? So it doesn't take a lot of thought to say, well, within 5 or 10 years, that section which is on the fringe will not really be on the fringe, right? Because
Yeah.
it will grow into the area. It'll grow into it. So, and that's really where the biggest growth. So that's where my head's at. Is I love it. It's going fantastic. I think it's great to see innovation in meeting consumer needs, right? And so this is an innovation in the meeting of consumer needs, that people want extra space, they don't want to or don't have the capital to put into a home, but they want the use of the space. And I see it's great that our industry is able to respond to meet that consumer need. It's a very positive development.
Let's wrap up with a few big picture kind of questions. Let's start with investors and finance. Where do you see or are seeing most of your investor attention going right now in say the sectors you cover?
Yeah. Well, so if you think about this, it's really a question of which investor with what return threshold. And that's really the issue at hand, right? So, and usually it starts at the top tier of the investment world with the lowest sort of required returns, and then things cascade down. Okay, honestly. So what has been happening in the sectors that I cover is office investment was the purview of organizations that had needed to write a very big check, that were looking for sort of bond-like returns, and loved office because of the both large amount, the marquee locations, the creation of wealth in these international gateway cities. And that capital, which was a significant amount of capital, is not necessarily going back into office, is looking for a home elsewhere, right? And that capital had tended to be concentrated into the large international gateway cities. Okay, so as that capital has moved out of those cities into what we would call the next tier of the top 30 or 40 metropolitan areas in the U.S., we would call them tech hub-ish, right? Mm-hmm. They have entered those markets with lower return expectations than the investors currently in them. Okay. And so and prices have gone up, values have gone up. And that means then those investors have said, all right, well, I'm either going to have to go further out in that metropolitan area, find a more deeply distressed property if I can, or I'm also going to search for new markets that were smaller than the top 30, 40 markets I was playing in. So there's a cascading movement of investors, basically deploying their capital to try to hit their returns. All right. And so it flows from the international gateway cities to the tech hubs, the tertiaries to the, fourth level metropolitan area. I get
Courtyard area. I don't know.
Yeah. Every time I try to say that, I can't come up with a term, or we have other folks who are just sort of saying, you know what? I know these cities. I'm going to basically go into development. I saw a lot of developers that were only doing core high-rise international gateway cities say, nope, I'm going to the next 30, 40 cities. I'm buying every damn piece of land I can get my hand on in the suburbs, and we are building. And they are. Okay. So
but they're not omnivorous in the sense. I mean, are they thinking BFR? Are they thinking apartments?
No, they're thinking apartments. Or what I meant was, you also have a group of developers, right, that were funded by big institutions, big life insurance companies, international investors who were building either office or they were building multifamily international gateway cities. And they've just said, I'm just going to pick up my chips, and I'm going to go to an Austin, a Dallas, an Atlanta, a Tampa, an Orlando, a Nashville, a Raleigh. And like, we look at the demographics, they look at the land, they say, okay, where could I buy a land that's in the suburbs? Boom, I'm going. Yeah. So that is kind of playing itself out. Yes, costs of construction have gone up. Material costs have gone up. But rents have gone up a lot too, right? Yeah. So it hasn't stopped development. There's been pauses, right, where people need to say, okay, I need to redo my numbers, see if they still pencil, right? Yeah. So yes, but things are moving pretty nicely. So the investment community is very active. There's a lot of capital that wants to find a home. There's no crazy underwriting, like it's not nuts. There is a reasonable amount of discipline. There's also a reasonable amount of transparencies in these industries. So it's not opaque. People know how much supply there is. They can estimate, where they know where the next deal is, because services like mine expose that information.
Mm-hmm.
So there's a fair amount of transparency in these previously opaque asset types, which have tended to reduce the fluctuation in supply overhang. If you go back historically, the amount of supply overhang has progressively gotten squeezed out over the last 20, 30 years.
Yeah. How about in terms of the motivations? We talked a little bit ago about this great migration.
Yes.
I mean, on a national level, these folks have followed the activity into these new and upcoming emerging growth markets.
Yes. Investors are, look, the reality is, it is driven by the fundamentals of population movement and the earnings power and wealth of those populations, right? So what we are seeing is, again, if you remember, the renovation of the urban core was a 1990 to 2020 experience, 30 years, where the urban cores that have been hollowed out in the 68, 69 period and the 70s came back, and those cities became revitalized. Now, it also was coincident with the sort of millennial generation entering the workforce, right? So there was a movement from the suburbs into urban areas because the demographics favored it. Mm-hmm. We always knew that as the millennial generation aged, which is very large, I think 88 million or so, that as they aged, there would be a gradual movement to the suburbs. We also knew that there would be a gradual movement to lower cost cities, because not everybody would become a gazillionaire, and they would acquire obligations, and at some point they couldn't afford a home in San Francisco, and they'd have to move. And these things were already happening. They were happening a little bit on a slow roll. COVID just turbocharged everything.
Yeah.
Okay, you had about 5 or 6 years worth of migration happen in about 6 to 7 months. And then you've got this overlay, right? So the movement of people isn't done yet, because people are still sorting out, like, where do I want to live? Where do I want to work? Where do I need to work? That's all still happening. And I think there's another 2 years at least of the population sorting itself out, and investor activity is just going to follow the people.
Yeah.
Flat out. I mean, and
on the market, on a market basis, then that's been this kind of flight from urban to suburban or exurban spaces.
But understand, like, so there is a recovery, though. I don't want to be like too, like, Cassandra-like, right? Mm-hmm. There is a recovery which has occurred in the international gateway urban cores, right? There are younger people who do want to live there. If they don't have to work there, they want to live there for the sort of for the lifestyle, for the urban, for the number of other people that they'll meet. So it's not as if those urban cores, those international gateway cities, are dead. Far from it. Okay, far from it. They do face some headwinds. They still have some new supply coming on. The demand will be among younger folks. Remember, you've also had like 2 years of migration that would have gone into the urban centers, didn't happen. And so that will kind of come back. And so you'll see a bit of a pop. I don't think you'll see the rapid kind of rent growth in the urban cores that we used to see, right? I think it'll be more muted because you don't have the demographic tailwind in those places that you had 6, 7 years ago.
Yeah, I agree. We see some signs that urban is coming back and being a little more, just from the waning of COVID. But the siren song of twice the house for a third the price is pretty powerful. I mean, do you see labor? It seems really does want to work from home for that reason. Do you see there being a battle here?
You have to slice this by demographic and also psychographic components, right? So, because the population is aging, and it is aging, right? And more the center of gravity is shifting a bit middle age-ish. Okay, so yes, you have a fair number of people in this demographic bulge who are like, I didn't become a gazillionaire. I've got a family, right? And so there's a big pull to those secondary cities and the suburbs of those. By the way, there's also a continued vitalization of the secondary cities urban core. those are vibrant neighborhoods and those are vibrant areas. So I guess what I'm kind of saying is that there is a lot that's in flux. A lot of people are in flux. You have, there's a declining birth rate there, and the population growth is the lowest it's been in a very long time.
Mm-hmm.
So you have this sort of you have sort of working conditions have changed, but you have a backdrop to that of demographic, and all this is sort of playing out, right? And so there's still a lot in play. There's also been, if you look at sort of the recovery, there are all these supply disruptions, inflation, and quite frankly, the question about how durable inflation is. The Fed thinks it's transitory. I'm thinking it's a little more permanent, because as the transitory components fade, the cost of housing is not transitory. It is more permanent, and it's really a function of people going from high cost areas to lower cost areas. So while it looks like, right, that rents are up a gazillion, and they are, but if you think about the people who are paying it, it's not a burden to them, because they were paying higher, right? So they were paying higher prices. And really, with pre-COVID, we had this big problem thinking about economic growth is concentrated. You can't get new supply in these global gateway cities. Prices are rising, and we've got this sort of existential affordability crisis. Well, to a certain extent, the affordability crisis is being, to a certain extent, solved by the movement of people from high-cost cities to low-cost cities. So it's a great free market experiment in that the regulatory structure couldn't solve this problem. And so the movement of people is on its way to doing that.
I just think that in a lot of these metro areas where you do, I agree. It's not like urban is dead, but when Tim Cook said we want to go back to 3 days a week for everybody, my understanding, I heard anecdotally that there was a tremendous amount of pushback from Apple's workforce, and those tech companies need talent, and if the talent says, "Sorry, I want to work from home," I think they're going to work. They're going to win, at least for now.
And so this is where this is all playing out, right? Because if, let's say, even if a company wants it for cultural reasons, they want people back together because they think it'll help for their culture. Well, the labor market for office workers is tight. So it is at the point of if I want to work from home and you don't want me to, guess what? See you later. I got options. I don't need to be dictated to.
Yeah.
Right.
For now, they win. We'll see what happens in
for now. But if you think about, if I look at the economy, I don't see a recession. Okay. I see potential inflation, but I don't see a recession until the Fed actually does something to stop it. And that's not going to happen for several years out. So we're going to have a pretty tight labor market for the next several years. And remember, so now you've got not just 2 years of changed habits, you're maybe up to 4 years of changed habits. And so the longer something new re-solidifies, the harder it is to go back to exactly the way it was. And quite frankly, our company is going through the same. We're a tech company. We're a more mature tech company, but our people like working from home. Our offices are open, but no one's showing up. I manage 3 offices for our company, and we're open. Anyone can, if they're vaccinated and they want to come back to the office, they're welcome to come back. I can count on less than one hand the number of people per day that are in any one of these offices.
Wow, that's true. I hear the culture thing, and that's not untrue.
There is truth to that.
There is truth to that, but I also hear I think it was Tim Cook again, not to pick on Tim Cook, he can handle it, but it was like, so many great ideas happen at the water cooler. I'm thinking, really, Tim? Or is that just because you bought a ton and built an immense amount of office space and you need to use it?
I do think there's something to it. And here's what I would say, that it's very hard to bring in new people and to establish tight bonds and to form a connection with a team. Now, we've been living, quite frankly, I think as a workforce, we've been living off of the relationships that were previously built. And it's pretty good, but I do think that the pace of change and innovation has taken a little bit of a hit. I
Yeah.
think that that's
Yeah.
true. People are, however, if you're talking about stable processes, and this is where, again, where you kind of companies that have stable processes, well, people are far happier executing those stable processes, not in an office. So
Yeah.
it's only where
Yeah.
you've got like unstable processes where new things really have to change. That's why the deal teams, right? Or
Mhm.
maybe the sort of product development teams, right? That are innovating the ideas of what to do, not how to do it, but what to do in the first place. They kind of need
Yeah.
together. But if you think about that as a percentage of the entire workforce of a company, it's not that big.
That's true. Yeah,
Right? It's
exactly.
not that big. And so that's what I'm saying is like, there's a third of the workforce probably is going to go back
Yeah.
to work full time, 5 days a week, because that function needs it. Okay. But it's much more at a function by function, team by team decision as to where the value of work is relative to also the sort of efficiency and retention of talent.
Yeah, I think for at least for the next several, until the economy slows down markedly and unemployment rises, I see labor winning and work from home being a revolution, not an evolution, and being just a huge part of the workforce. Let's talk about labor, though, in terms of supply. I mean, like you mentioned a minute ago, labor is in short supply almost at every sector. Do you see that as kind of a governor on residential and other supply? It can't be built and fast enough?
Well, there is something to be said about that. I mean, the supply of construction labor. Okay, there's been shortages and disruptions of construction labor supply pre-COVID, and that was a pre-existing problem because wages were rising in major cities, and there had not been a curtailment of new immigration, which had tended in large part to be construction workers, right? So there was already a problem. That problem has been amplified, even though construction itself was considered kind of mission critical and continued through the COVID period. It is a governor. It is a regulator. Let's put it that way. Of the ability to add new supply, also construction costs themselves and material costs themselves. So it's not easy to be in the construction business now. You've got a whole bunch of other of problems, and yes, there are supply disruptions, but it's also affecting. So if you kind of peel this back a little bit, the labor force participation rate of people over 55 has declined 3 or 4 points. Yeah. We were kind of banking as an economy that labor force participation rate would stay high and perhaps even go higher, right? Because people were living longer, they had the ability to work longer, and frankly, we needed them to work longer. So that's a bit of a problem, right? I'll call it at the upper end of the economy, and then childcare issues and schools have kept some working women out of the labor force for some period of time. And then at the very, very bottom end of the economic scale, though there is some discussion or potential dispute about that, economic reasons would sort of lead you to believe, and it's hard not to, is that if you pay people more not to work than to work, they're probably not going to work. And the unemployment insurance was very, very generous.
That's true
for that segment. Now that's burned off. And so we'll see how we hope to see a response to that as more people sort of re-enter the workforce, and there are jobs to be had. So we hope that will happen.
That's true. I would push back on that a little bit. My understanding is the studies that have been done to date have shown this not a big motivator.
Again,
of that.
There's something here. There's a dispute about that. About how big an effect is it? And the problem is you have multiple things going on, right? You have childcare issues. You have certain folks who are health compromised, and so they couldn't really kind of work. And they were largely face to face. So it's a mixture of issues, as is most things in life.
Yeah. And if the job you're offering is a really crappy job with low pay, you maybe have yourself to blame for that. Let's talk about how. Speaking of costs, though, do you guys track cost in?
Well, I mean, we don't formally track, construction costs or anything like that. I mean, we are sort of keep track of it in a generalized sense, but that really isn't sort of in our wheelhouse. I mean, I know it because I know folks in the industry, and a lot of my friends are in the sort of development business. But look, material costs are up, labor costs are up. It is in very few places, it's not any easier to get projects, approved. And this was an emphasis for quite a while of trying to make it easier to get stuff approved, but it's not been easier to get stuff approved. We hope that this might change, but localities have not been, very accommodative, right, to the addition of new supply in their community, except when there is a very large consensus of the need for new housing supply. There's a natural inclination to restrict supply because the homeowners want higher values.
Or just don't want congestion, et cetera.
Again, you can wrap that into a lot of other issues, but there's a natural inclination, to restrict supply, and so there have to be other sort of part of a public, consensus that you have to support growth by adding supply at a reasonable rate.
Let's end with kind of a potential solution, going back to labor and even just the speed of construction, the ability to build things. What do you think about automation and even more efficient kind of modular or offsite construction system? Do you see that kind of becoming, is this the time for that to get big?
There has been so many attempts, right? So many attempts to try to improve the construction process and bring down the costs and either build it in factories or build modules in factories. It's a very difficult thing to get done. I'll call it logistically. There's been lots of, the modular work that has been successful was mostly limited service hotels with very high costs of labor. I saw that, there's been some encouragement of some of these techniques. It's still been very capital intensive, and there's also been regulatory kind of obstacles thrown in its path that make that more difficult in terms of getting COs and permits and such. Okay. I hope it, I hope so. It would be a great thing if we could deliver housing at lower costs. But remember, about a third of the cost of housing is in the regulatory process. Mm-hmm. So there's a lot of cost that has got nothing to do with the hard cost of construction in terms of the final delivered financed cost. So about a third of it is regulatory in nature. So there's opportunities to yes, but it's very capital intensive. And boy, I've seen a lot of people just, Katera is the classic case of, it all looked so exciting, all right? Like it all seems so good, but it's very, very capital intensive, and it's hard to scale.
It always seems like it's the next big thing that's going to happen. We did one of the early podcasts here on this issue like 3 years ago, and I really thought that this is ready. This is the catalyst, the shortage of labor that was going to kick this up into a new level, and it just hasn't happened yet. It's too bad.
Well, if you go, like, I'm a little sort of bit of a historian. These things take time. Innovation and technological change takes sometimes 30, 40, 50 years for people to fail multiple times for just the right combination to come together and succeed. I wouldn't count this out. I think there's a big need, and the dollars are huge. So I think people will continue to experiment and try, but it's been littered with a lot of people have tried very hard and have really kind of hit the rocks. So I'm hopeful, but boy, I don't think I personally would invest in one of these ventures.
Okay. All right. Well, Jeff, I appreciate you coming on. We learned a lot about a lot. Sometimes you learn a little about a lot or a lot about a little. This was kind of a lot about a lot. I appreciate you coming on.
I hope everyone got something out of it, and would love to chat with anybody who wants some more detail behind all this stuff. Thank you very much for
Awesome.
having me on the show.
Hey, thanks for coming on. This has been New Home Insights. I'm Dean Worley. We'll catch you next time.